Small caps have done extremely well post-COVID crisis, and that led many people to dabble in the small caps. This video is intended to test the hypothesis if small caps do better than the large caps. So by classification, top 100 companies by market cap are large caps. Companies from 251st in size to 500 are called small caps. So here Nifty 100 data is from 2007, and this data is picked from Google Finance. Using this data, I have calculated rolling returns from 1, 2, 3, 5, 7, 10, and 15 years. The median returns for Nifty 100 are hovering around 11%. If you look at this point, right, it's around 11%, 10.9 to 11.2, something like that. And there are no negative returns when the vintage is over 5 years, over 7 years actually. The lowest return after 15 years is around 7.4%, and the maximum being around 16%, that is 15.9%, right? We have done similar exercise for small caps, and the median returns are around 12% here, and no returns, no negative returns after vintage of 10 years. And the lowest return after 15 years is around 5%, and the highest being around 20%. When we compare large cap and small cap data, the median returns are 11% and 12% respectively. But dispersion between the minimum to median and maximum return is highest in small caps, indicating a higher volatility here. So in the last 10 years, there have been many important reforms, and GST definitely ranks as the top, as this led to the formalization of economy in a big way. In order to see the impact of this reform, we have looked at the rolling returns of Nifty 100 and small caps before and after GST. So before GST, Nifty 100 delivered median return around 10%, right? So it is like 8% is something which has been there, 11%, 10%, and over a 5-year period is what we have to look at the horizons. And there are no negative returns after a vintage of 5 years. And for 7 years, the maximum median mean are around 9.5%, right? The minimum is around 7%. Similarly, for small cap, the median returns varied hugely. If you look at it like 1 year rolling return, the median has been around 1.3%. 5 years, it is around 6%, and 7 years, it is around 7.5%. So the max mean and median for 7-year period are between 7.5% to 9%, making it less resilient compared to the Nifty 500. So now let's look at what happened after GST came into effect in July 2017. So the large caps have a median of around 13%, right? This is across the time horizons, with no negative returns after a vintage of 3 years. For time horizons over 7 years, large caps have delivered returns anywhere between 10.6% to 15.3%. Now, let's just look at the small caps and what happened there. So the median returns are like hovering from 14 to 26% across the time horizons. So for 7 years, it is around 18%, 17.85% exactly. And there are no negative returns for a vintage of over 5%. And over 7 years, small caps have delivered returns between 13.5 to 20%, making them more resilient compared to large caps. This is after the GST. So following things can be concluded. Despite the median returns for both large and small caps are around 11-12% if you are looking from 2010 to 2017 data. So there are time periods where large caps perform better than the small caps, and vice versa is also true. After reforms like GST, small caps have become more resilient, and the present loss in the company prevent the income leakages which used to occur in the past, leading to better corporate governance. So that makes small caps a bit more attractive compared to how they used to be in the past. And the small caps have also grown in size. Many companies in this 250 range, right, 251 to 500 range, are comparable to the size of large caps in early 2000s, making them more resilient. And finally, the disclaimer. So the video is for educational purpose only, and it is neither a recommendation to buy nor sell the asset class in discussion. Thank you.